The IRS just released the new 2026 tax brackets, and even a small change in these numbers could cost you thousands of dollars, or it could help you save big time, depending on how prepared you are. Most people think tax brackets are simple, and everything's taxed at the same rate, but that's just not how it works. And misunderstanding it, not knowing what to track, that's what keeps a lot of people overpaying taxes year after year. So in this video, I'll show you exactly how tax brackets actually work, what's changing come 2026, and what you can do now to keep more of your hard-earned money before the new rates kick in. Let's dive in. Let's start with the biggest misconception. A lot of people think I make $400,000 a year, so I'm just taxed at 25% on that entire amount. And it's just not true. So the US uses a progressive tax system. That means your income is taxed in chunks, and each chunk is taxed at a different rate. So let's use some simple numbers. The first portion of your income, the first $12,000, is taxed at 10%. The next chunk is taxed at 12%, then 22, 24, 32, 35%, and so on. As your income climbs, only the dollars within each bracket are taxed at that bracket's rate. So if you earn $100,000, not all of that's taxed at 24%. Most of it is actually taxed at lower rates. This is why understanding tax brackets matters, because even small bracket changes can affect how much of your income gets taxed at each level. Every year, the IRS adjusts tax brackets slightly to keep up with inflation. This year, those adjustments are more noticeable. So let's break down the 2026 federal tax bracket, starting with single filers. If your income range is $0 to $12,400, the first $12,400, that's taxed at 10%. From $12,401 up to $50,400, that's a 12% tax bracket. $50,401 up to $115,700 is 22%. $115,701 up to $211,775 is taxed at 24%. $211,776 up to $256,225 is taxed at 32%. And 35% tax is when you start achieving $256,000, $226, upwards to $640,600. That's taxed at 35%. And finally, anything over $640,601 is taxed at the highest bracket of 37%. Now for married filing jointly, from $0 to $24,800, it's taxed at 10%. From $24,801 upwards to $100,800, you're taxed at 12%. $100,801 up to $211,400 is taxed at 22%. $211,401 up to $343,550 is going to be at a 24% tax bracket. And then you have $343,551 up to the $512,450 is going to be taxed at 32%. $512,451 up to $768,700 is taxed at 35%. And finally, for married filing jointly couple, anything over $768,000, 701 is going to be taxed at the highest rate of 37%. So even small shifts in these brackets can actually move your income to higher or lower tiers, which can raise or lower your overall tax bill. Let's take a pause here. If you're a high W-2 earner earning over $300,000 a year and you're seeing a huge chunk of your income disappear to taxes, listen up. In the last 12 months, we've helped over 250 clients save over $10 million in taxes using our tax return system. Our average client saving about $40,000 in taxes. This could potentially 3x your refund this year without changing your CPA, without changing your lifestyle, and without wasting hours of tax planning and not knowing exactly what to do. Click the link in the description to book your free strategy session. That's it for now. Let's talk about the next big update and the standard deduction. If you don't itemize deductions, this is the amount you can automatically subtract from your taxable income. So the new numbers for 2026 compared to 2025, and for a single filer in 2025, $15,750 was the standard deduction. In 2026, it's bumping up a few $100, $16,100. For a married filing jointly couple, 2025 it was $31,500. 2026 it's going to be $32,200. So yes, your taxable income automatically drops by this amount before the IRS applies tax rates. This increase is designed to help offset inflation, but if your income also went up because of cost of living, raises, other adjustments, this extra cushion may not fully cancel it out. And again, this is only a standard deduction. So if you look to itemize, you can itemize your deductions and get significantly more than the standard deduction. The big beautiful bill pass, it's now up to $40,000 for your SALT taxes, which is a huge benefit to anybody who has mortgage interest or live in high state income areas. So why do these changes happen? Because inflation makes everything more expensive, from housing to groceries, your clothing, your cars. I mean, you guys see it when you go out to eat with your family. In 2025, the consumer price index rose about 2 to 4%, but many people feel it's way higher in real life. So the IRS adjusts these tax brackets every year to prevent what's called bracket creep. And this is when your income stays about the same, but because of inflation, you get pushed into higher tax brackets anyways. You end up paying more in taxes, even though your buying power did not increase. By adjusting the brackets, the IRS tries to make sure you're only taxed when your real income and your real purchasing power actually goes up. They do their best. So this means in 2026, you'll need to earn a little bit more than in 2025 to move into the same higher tax bracket. That can help some taxpayers keep more money, and it could also push taxpayers into a tier higher if their income grows faster than inflation. So bracket changes might seem small, but they can make a big difference, especially if you're not planning ahead. And so for example, if your income rises but you don't adjust your tax strategy, you could get pushed into higher brackets and owe more. If your income stays the same, you might fall into a lower bracket, you could save a bit, but also you have to understand your purchasing power has also decreased due to inflation. But the real opportunity, where does it come from? Where it comes from is being proactive, planning ahead, getting started, and making sure that you have a plan in place not to bump up in different tax brackets, but to strategically drop down in lower tax brackets and tiers. Here's just a few smart moves that you and other people can use to stay ahead of the tax bracket changes. Very simply, you could reach out to your HR, you could adjust your withholdings or estimated tax payments early. You could time your income in different deductions to stay in lower tax bracket. You could use the tax advantage accounts, HSAs, retirement accounts, IRAs, Roth conversions. You could structure a new business, take depreciation, expense more of your overhead that you have. You could invest into smarter income and cash flow. If you have side income or you own a business, you could reinvest further into your business, build a larger foundation, increase the marketing spend, focus on client retention, creating some sort of loyalty program. Be strategic and take more losses in the process. And remember, these bracket changes can also affect your retirement planning, investment strategies, how much you can deduct or contribute in certain areas and at certain times in your life. Your tax bracket impacts way more than just the check you write to the IRS. So if you want to keep more of your income this year and 3x your tax return legally, don't wait until next April. The 2026 tax brackets are already changing, and smart planning can save you thousands and tens of thousands of dollars later in the year. So click the top link in the description to book your free strategy session. You'll get a custom plan to reduce your tax bill without changing your CPA, your job, or your lifestyle. We'll show you how to adjust your withholdings before it's too late. Time income and deductions so it's your advantage. Use the tax advantage accounts like the HSAs, 401ks. If you have a business, maybe a solo 401k. Structuring side income and investments the right way. Maximize your tax savings is the ultimate goal, and building more wealth faster in the process. So this is not just about taxes. Your bracket impacts your retirement, your lifestyle, how fast you build wealth for your next generation. Don't leave this to chance. Let's help you keep more of what you earn. And at the end of the day, understanding the brackets and just having diligence on what that actually means is going to help you build more wealth faster and serve your next generation at a higher level. So by not doing this, it'd be a disservice to the ones you love and are closest to you. So building a strategy around your situation is where real savings and real wealth will come from. So whether you're earning $250,000 a year or over $1 million a year, these adjustments are happening and the tax code is consistently changing around you. If you don't plan ahead, you could be handing over tens of thousands, if not even hundreds of thousands of dollars more than what's actually necessary. And if you want to keep more of what you earn and stop stressing every April, hit subscribe, click the link below, give me a like, share it with friends and family. I'll keep you guys updated with proven strategies to lower your tax bill, build wealth, plan smarter, just like we've helped over 250 clients do so in the past 12 months, save over $10 million. The IRS already made its move. Now it's your turn. Don't be left behind.